A big sell-off in stocks because of Fed worries and war talk. Lots of red ink again all over the place this morning. Look who's here. Michael Lee, the Super Bull himself. Look, Michael, before we get into your outlook, tell me this. What happens to stocks if the Russians do launch an invasion of Ukraine?
Stuart, that can't be good for the stock market. I think it depends on the scale of the invasion, how long it takes, and how much advance notice we have.
Would you get a sharp sell-off? Is that what we're looking at?
Yeah, well, I think in the first news that the attack is imminent, right? And so if we know a few days in advance it'll have it, then the market will price it in and move on. But if there's very all of a sudden attacks, if there's, kind of a sneak attack in the middle of the night and it's very aggressive, I can't imagine that'd be good for stocks.
Got it.
That sort of conflict, especially given the Biden family ties to Ukraine and the urge and desire of Washington, D.C. to go to war, it's not going to be good for our markets.
Okay, now look, here we are, deep in the red, and you are a Super Bull. What do you say now?
Well, Stuart, what I would say is the one thing I've been saying, the one hedge I've made to my Super Bowl stance for the last 8 to 9 months is the Fed could completely derail this market. And I don't know necessarily that the Fed is derailing it. It's just there's so much uncertainty as what the Fed is going to do, not just in this meeting and in March when there's rate liftoff. It's over the next 6 to 18 months. What's rate normalization going to look like?
Wait a second. Tomorrow afternoon, Wednesday afternoon, we'll hear from the Fed itself. If the market thinks that they're going to come down hard with a lot of interest rate hikes, then I presume that would end your bullishness. You would look to the market to go down. Is that correct?
Well, in the short term, what I would say is that this is not the first Fed-led sell-off over the last decade. We had ones in 2018, 2016, 2015, 2014, 2013, 2011, 2010. Anybody who bought on those weaknesses was handsomely rewarded. However, in the interim, it gets very, very ugly. And what's changed over the course of the last decade is this momentum, computer-driven electronic trading that pushes assets around in the blink of an eye. I've never seen 5% intraday moves on an index like the NASDAQ, like we saw yesterday. So there's massive amounts of cash, massive amounts of power from these computer-driven algorithms. So markets can whipsaw around quicker than you and I can blink. And so I think this will be the ugliest kind of phase in the market we've seen. I wouldn't be surprised if we recover a lot of the 8% losses we've seen this year, only to come back down and touch the lows we saw yesterday until this gets resolved. And if you think about it, that makes sense. You have a wide range of viewpoints of where interest rates are going, and until that consensus can be narrowed, you simply can't value risk assets without a consensus of where the U.S. Treasury curve is going to be.
Extreme volatility in the short term. Here we go. Michael, thank you very much for being here today. Crucial day. Thanks for being here. Back to the crypto.